Perfect. Let's get started then. Today's discussion is around financial reporting quality, financial analysis techniques, and a small add-on which CF has done in terms of introduction to financial statement modeling. Out of the three, I think the most important is financial analysis technique. I think the most important part of the syllabus. And there are a lot of questions as well as I think it's one of the most important things in the field of finance, which is ratio analysis. So I think your focus should be more on financial analysis techniques. I think that is the most important of the lot that we have here. Let's get started with financial reporting quality. Now, when we say financial reporting quality, obviously we go a long way in talking about how the quality for financial statements should be. What are we trying to assess when we are saying financial statement quality? Now, financial statements can be either high quality or low quality financial statements, which means they may provide you useful information about the company if they are high quality, and the assessment of the company's performance and the prospects of the company can be better understood if it's a high quality financial reporting that the business has done. What do we mean by high quality? There are very less chances of manipulation, and you will believe a high quality financial statement provides you complete and accurate information, right? So the ideal objective for every firm is to provide a high quality financial statement. However, it's not always high quality that is getting reported. A lot of times across the geographies, whether it's Asia, whether it's Europe, whether it is US, we have seen certain companies resorting to low quality financial reporting, which typically leads to some type of scams or scandals around these businesses. These low quality statements provide incomplete, inaccurate, and inadequate information, right? So it could be something which is not reliable. And because they are not reliable, the reason is there are possibilities of manipulation or what is also called as window dressing, right? So a lot of times these accounts are also window dressed, right? So window dressing of the accounts is done. And the objective of doing a window dressing is to artificially either inflate or deflate certain numbers. The objective is not always to inflate. The objective may also be to deflate certain numbers. You may not, at times you may not want to show higher numbers, right? Sometimes there's also an objective to show lower numbers by management, by companies. So what should be a very high quality financial statement, a very high quality output, may generally turn out to be a very bad low quality output, and that is not desirable. From a financial statement analysis perspective, please remember the statements basically are input to financial analysis, right? And if your statements are not reliable at all, your financial analysis is completely waste. Then I don't think what type of financial analysis we would like to look into. So there's always this problem that financial statements have to be prepared in accordance with the highest quality of standards available, and management should ensure that that is something that is done with utmost importance. An auditor are obviously there to ensure that these statements are true and correct. So when we say you have a very high quality financial reporting that has been done, it will enable assessment of the firm. You can have a better assessment of the firm, and obviously high quality earnings will lead to increase in the value of the company, right? Generally, the equity markets will pay a premium for quality, right? There are certain companies which get a premium because they are great in financial reporting, right? Or their financial reporting quality is top notch. They will provide you enough disclosures so that there will be a lot of disclosures in the financial statement, right? They tend to, they do not tend to hide information. They provide data to analyze, right? And most of this is something which is publicly available information. However, if there is a low quality financial reporting done, then it will delay your assessment of earnings and valuation, right? It eventually leads to decrease in company value. So as soon as the equity markets come to know that your financial reporting is not perfect, there are some types of problems with the financial reporting, obviously that will lead to a decline in the value of the business also, right? So you typically see a decrease in the company valuation when the financial reporting quality is not up to the mark. Now, What is this quality spectrum of financial reports that we are talking about? Now, remember, these are quality spectrums, right? So it goes from best to worst. From best to worst, first, your reporting is compliant with GAAP. You are following all generally accepted accounting principles and policies. They are decision useful and earnings are sustainable and adequate, right? Which means your earnings are also sustainable. These earnings are going to stay, right? Sustainable means they are going to stay there for a long period of time. Reporting gets slightly average when we say you are compliant with GAAP, decision useful, but earning quality is low, which means there is earnings are not sustainable or not adequate, right? That means this year you have reported very high profit, but again, that profit may not last, right? Like we talked about LIFO liquidation, right? So it's not illegal. You have not done anything illegal. There is not something which is unethical. LIFO liquidation can happen, but this is not sustainable, right? You're reporting a very high quality of or very high profit, but that quality is low because we know it's not sustainable. It is going to flatten out after a period of time. Then what can go worse? You are still compliant with GAAP, earnings quality is low, and reporting choices and estimates are biased. So now slightly we are seeing management biases kicking in, right? Management is biased. And whenever there is management biases kicking in, we'll say, okay, the reporting quality has gone to a mediocre level. Next, you're still compliant with GAAP, but amount of earnings is actively managed to increase, decrease, or smooth earnings, right? Active management of profits are getting done that to showcase a increase, decrease, or smooth reported earnings, right? So now you have an actively managed earning that we are looking at. Finally, you have one of the biggest problems. Reporting is not compliant with GAAP. Not compliant with GAAP means now you're not even following accounting principles. Although the numbers presented are based on company's actual economic activity, right? But you're not compliant with GAAP and it is now getting closer to the worst end of the spectrum. Finally, not compliant and includes numbers that are essentially fictitious or fraudulent. And this becomes the final nail in the coffin for a business from a financial reporting perspective. So you can find businesses or financial reports which spread across the spectrum from the best to the worst, right? And ideally, the businesses would like to be classified here, but then there is a possibility that you may find certain businesses on the worst end of the spectrum. Now, what are these biased accounting choices or what are these, gap related issues? But again, earnings are managed. What do we mean when we say actively managed? Uh, so let's talk about them or management biases. What are your biased accounting choices? You are not your accounting choices or your financial reports are not faithful representation of the economic circumstances. Simply means aggressive approach, conservative approach. Aggressive approach means you are increasing revenue and earnings, but may decrease reported performance in later years. You are showing very high earnings today. And therefore, the choice of making or reporting revenue is very aggressive. It's not something which is conservative. While accounting says be conservative. Then the conservative approach says, in contrast to aggressive approach, it may reduce revenue, earnings, cash flow from operation, and it may increase the company's reported performance in later periods. So the idea is your choices are ensuring whether you report aggressive or conservative approach. We need to pick up whatever is right. It is not a debate between aggressive and conservative. It is a debate between what is right and what is wrong here, what is correct and incorrect reporting, right? Either ways, you know, getting the profits today or pushing the profits to the later end, both of them are problem if they're not appropriate based on what the company is doing. So ideally, this is where the auditor should kick in and auditor should explain to the company and management and understand what is the appropriate way of reporting information. This is typically done to smooth earnings or ensure there is a volatility of earnings has been managed. Now, what is earnings management? Earnings management means intentional choices by management that results in biased financial reporting. So by default, certain choices are made by management which are biased. There's a very thin line between earnings management and biased accounting. Earnings management could be real earnings management when earnings are managed upwards through real actions. For example, you try and push orders from the clients to the next quarter. The client has given you an order today, right? Today it is 29th of March. Now the point is in 2 days we are going to end the quarter. So if you have achieved your sales for this quarter, you don't want to record that order in this quarter. You just push that order to the next quarter, which means you bill him on 1st of April. And as soon as you bill your client on 1st of April, you have managed the quarter, which means this quarter you don't want to show that sales, although it happened this quarter, but you're going to raise the invoice on 1st of April, which means you have pushed it through real actions in the next quarter. Now, this is called as earnings management. You are trying to report certain, sales in the next quarter, which should have been for the current quarter. Similarly, accounting earnings management, when earnings are managed upwards through accounting choices. Accounting choices means you might say that, okay, at present we have not signed a contract, or as present the payment has not been done, or the client has not agreed to it. So certain accounting guidelines can be managed in such a way that you push the earnings either to this quarter or to next quarter, depending on your requirement, right? So because there are obviously certain clauses which will help you decide whether that is this quarter or next quarter, right? So management takes that decision that, okay, we need to show it this quarter or not. Then non-compliant accounting is something which we said both of them are problem. Both these things are big problem from a financial reporting perspective. If there is a non-compliant accounting, it is not as per GAAP. It could be considered as low quality. Therefore, there would be difficulty in assessing the financials. On the other hand, fictitious transactions, misrepresentation of the company performance to obtain financing, right? A lot of people may report false data, and there have been several case studies in the past where false information has been presented to the stakeholders, and that is to either raise money or to perhaps showcase a performance which was never there, right? So it's a possibility that this was a performance never existed, but yes, it was just done to manage the performance. Now, when we say financial reporting quality as conservative and aggressive accounting, the aggressive approach means you are increasing revenue or profits in the current year, but may decrease the reported performance in the later year or vice versa for conservative approach. Now, it also depends on the CEO, right? So at times, what happens, your management change is going to happen next quarter, right? Or the management change is going to happen in the current quarter. So then the management decides, okay, do I want to show all the losses this quarter, or do I want to show losses next quarter also? For example, you change a bank CEO or MD in between. So what does the bank new CEO MD does? That person uses the current quarter to record all the losses or all the provisioning. The reason being he's going to blame it on the outgoing CEO that, okay, under his tenure there were a lot of losses. In next quarter he will start a fresh zero and showcase, okay, in my tenure the losses were very limited. So this might happen where sometimes you might want to show it today versus next year, or next year versus today. Conservatism does not support neutrality because it's asymmetric nature, right? So as I said, it's not necessary that conservatism is always right. We need to be neutral. We need to figure out what is the correct approach. It is characterized as a delay in profit recognition. If you are conservative, you are delaying profit recognition, which is also wrong. So in conservatism, an analyst should always be aware of the implication of accounting standards. For example, treatment of long-lived assets is different under IFRS and US GAAP. Under IFRS, if the recoverable amount is less than carrying amount, an impairment charge will be recorded. While under US GAAP, if the sum of the undiscounted future cash flows from the asset is less than the carrying amount, then impairment charge will be recorded. So now an analyst should understand what is the impact of this on the accounting. If you're doing IFRS or US GAAP, be very clear you understand how does the impairment impact your financial statements. So a lot of times people say accounting is conservative, be conservative while doing accounting. It's not necessary that conservatism is right. Conservatism itself may delay profit recognition, and that may not be the right approach. So we need to find what is neutral, what is appropriate, right? Sometimes even aggressive accounting may be appropriate. That is how things are. But again, not necessarily conservative is always good. Conservatism in accounting standards. Examples: litigation losses. When the future cost is probable, expense recognition becomes required under both IFRS and US GAAP. So if you think that you are going to lose the litigation and future cost is probable, if future cost is probable, you will recognize the expense under both IFRS and US GAAP. Research cost. If future benefits of research cost is uncertain, both IFRS and US GAAP are going to tell you to expense them. Expense it immediately, do not capitalize, right? Because for capitalization, you need to have a technical feasibility. Then another line item like insurance recoverable. A company should not recognize a recovery amount until insurance company acknowledges the validity of the claimed amount, right? So until unless the insurance company says we are going to pay this money to you, you should not recognize it as an inflow for yourself. Be conservative. And then commodity inventories. An increase in the commodity market price may not be recognized until they are sold. This is classical commodity market phenomena. Think about silver, right? Silver went all the way to $120 per ounce. Now you might have silver and you might say, oh, I have silver and my silver price has increased. My inventory is now very valuable. But if you have not sold, you're not going to record this because silver came crashing down now to sub $70 per ounce levels. Yes, if you have sold it, you record. But if you have not sold it, you don't record the higher value. Be conservative. You don't even record at 70 because you have still not sold it. So the value of the silver may go anywhere from here. Then comes the forward foreign exchange markets. It protects contracting parties with less information due to asymmetrical information available and reduces possibility of litigation, as a result, litigation cost. If you are looking into foreign exchange as a variable, if your business is foreign exchange dependent, like you are an exporter or an importer, right? In either case, you can use forward markets for hedging purposes. Now, this protects interests of regulators and politicians by reducing the possibility of fault by companies. So financial and tax reporting rules are linked in many tax jurisdictions to avoid any frauds even in these markets. You have to be conservative while doing even foreign exchange related accounting or hedging. Mechanisms that discipline financial reporting qualities. Now, what can good lead to a good financial reporting quality? First and foremost, auditors. Auditors are the caretaker of financial statements. They provide financial statements to users with some assurance, right? So they need to assure, they need to sign on the financial statement and say that, okay, as per us, the financial statements look great. They have to ensure that the information complies with the relevant set of accounting standards. The auditors are the most important part of this puzzle. Then, to ensure that there is good quality of financial reporting, you can also have private contracting, which will monitor the company's performance to ensure the company's financial reports are of high quality. What is private contracting? Simple example, loan agreements or investment contracts, right? Sometimes when you take a loan, the bank keeps a check or the lender keeps a check on your company and on your financial statements. Why does that happen? Because the lender has to ensure that his money is safe, right? So the lender will do all the efforts to ensure that the reporting that you are doing is good, accurate, and is provided timely to a lot of people. So this is sort of a private contracting where, the lender automatically pushes you to provide reasonably good statements, and the lender has a very big, let's say, the team to take care of assessing these statements. It keeps you in check basically as a business. Then there are marketing regulatory authorities, which will help to minimize cost of capital, maximize reporting quality, right? Higher the quality, very important term, higher the quality of financial reporting, lesser is your cost of capital. which means people will trust your company's financial statements. And if there's trust, people will give you money at a lower rate. The cost of capital is lower. Many of world's security regulators are members of the International Organization of Securities Commission, right? And the primary purpose of being a member here is to ensure that rules and regulations are kept up to date, best practices are taken into consideration, and companies in your geography will follow all those rules and regulations. So having regulatory authorities is also a way to push companies to ensure that they are following all the rules and regulations. How do you detect then? And again, detection of financial reporting quality issues is to begin with something which is difficult. A lot of people tend to read statements, but it's very difficult at times to identify there are problems. But there could be warning signs. There could be signals that you may get. First, premature recognition of revenue. If a company is doing aggressive revenue recognition, that is a hint for you, or that is a warning sign that you might want to dig deeper into this. Higher profits driven by non-recurring transactions. What are non-recurring transactions? Non-recurring are nothing but one-time activities, right? So this time you got something which give you a higher profit. Next year you got something else which gives you a higher profit. So all these one-time transactions may give you higher profits, and your profits are driven primarily by these non-recurring transactions. Then delay in recognition of expenditures. Sometimes companies push expenditures lower, or they don't recognize at all, right? So for example, companies may have spent on advertisement heavily and have not recorded or do not record it this quarter. So the point is, advertisement, rebranding as an exercise of the company, why is not recorded is a big question. And reporting of assets at higher value and liabilities at lower values, once again, could be a possible sign that there is something wrong with the business. So such things should be kept in mind, such things should be observed while reading financial statements, and then identify what is going wrong from the perspective of financial reporting. The choices of presentation. In 90s, the massive restructuring charges of companies made uncertain the operating performance for many tech companies. And to counter these restructuring charges, companies started to sanitize earnings by eliminating charges in pro forma measures of financial reporting, right? So a lot of times companies do this. They have a cost. They tend to report something which is pro forma. Pro forma means projected. And they say, okay, no. If you exclude the restructuring, we are profitable. But the idea is, why should I exclude the restructuring? End of the day, it's a cost. Right. Today also a lot of companies will report adjusted EBITDA. They don't give you EBITDA. They will tell you adjusted EBITDA. And every time adjusted EBITDA is, excluding certain items. My point is, if I have to exclude certain items every quarter, then I'm not getting a true picture. Right? Adjusted EBITDA is always a way to showcase something which is not as good as it looks. So presentation choices are becoming interesting. People are now presenting adjusted EBITDA, maybe X of this, X of that. You have to just think about it. Is it a one-time cost? In popularity of pro forma earnings after 2001, companies started two accounting methods for recording acquisitions. One, pooling of interest, and second, purchase method. And as you go to level two, you will be taught pooling of interest and purchase method of acquisition based accounting. When you acquire companies, how do you do an accounting using pooling of interest or purchase methods? Now, these accounting choices and estimates do not necessarily involve complex accounting standards, right? Managers may change the assumption, and assumptions are something which are free to change, such as inventory cost flow method. And we did talk about, right? You can use a FIFO, you can use a LIFO, you can change the method, you can use a weighted average, your choice. Depreciation method, you can use a straight line depreciation, declining balance, double declining balance method, right? So again, these assumptions can change, and whenever these assumptions change, we are saying that there is a small problem in terms of estimates. Then estimates of uncollectible accounts can change, and deferred tax estimates to affect the earnings and balance sheet of the company can also change. And these are only indicative variables. Management can change any assumption to showcase a number which they think is reasonable. Simple example, to manipulate the earnings, managers can change the term of shipment Q1 to present a wrong number before the investors, because the shipment term can change the transfer of title from Q1 to Q2. So in Q1 you're saying ships 1500 bags, in Q2 you're saying receipt by customer. So now it depends, how do you classify it as revenue? Do you classify revenue like this or this? When you ship, do you classify it as revenue? Or when it's received by customer, you classify it as revenue. Accordingly, the revenue will change the quarter from Q1 to Q2. Choices, therefore, that affect financial reporting. Now, when we say choices, revenue recognition is the first thing there. Revenue is recognized upon shipment or upon delivery of goods, right? So you see now there are both options. Revenue is recognized upon shipment or upon delivery of goods. So the management has to be very careful, and they have to ensure they follow one set of rules. They don't keep changing the rules. Company may involve in channel stuffing. That is basically stuffing, not staffing. It's channel stuffing. Channel stuffing means to push your sales higher. You just sell products to the channel, which means you give the product to your wholesaler, to distributor, and the product is not getting sold to the retailer, from the retailer to the customer. The company, which is the original equipment manufacturer, is just selling it to the distributor or the wholesaler. You are filling your channel. You're just giving it to your wholesaler distributor. You are stuffing them. Whether the wholesaler distributor is able to sell it to a retailer, or is the retailer able to sell it to a customer, that we don't care. We are just stuffing the channel, because as soon as I stuff the channel, I may record it as sales. So sometimes companies may just stuff the channel to record higher sales. Engaging in bill and hold transaction, which means you bill your customers, but you hold to record that as sales in a specific quarter. And several other techniques like rebates, outstanding sales, collection issues. Is the company's revenue arrangement separated into multiple deliverables of goods or services? Can you segregate company revenues? Further, in intangible capitalization, companies decide whether they want to capitalize and amortization policies in comparison with competitors. Are you in line with competitors? Or is this something where your policy is getting different than what the competitor policies are? Then there is also depreciation policies. Are the estimated life of assets similar or low in comparison with competitor or industry? And changes in depreciable lives that have effect on earnings. In both these cases, we are saying that there is something which is going wrong from a business perspective. Maybe we are not in line with the industry. Our reporting is different than the industry. And then that is a warning sign for the analyst. Why is the company reporting not in line with the industry practice? Like, for example, in the industry, let's say everyone follows FIFO. Then why are you following a LIFO accounting framework is something that you need to understand and dig deep into. So the choices made while reporting or financial reporting are very, very important to understand. It's not unethical, right? This is not unethical, right? You can do LIFO, but then we need to understand what is the impact of LIFO. You're not doing something which is illegal, but the impact has to be assessed and figured out, okay, is this something that will sail through or not? Allowance for doubtful accounts, loan loss reserves, which means it includes the justification of collection of experiences and allowance from the past. This simply means how much will be doubtful accounts, how many customers will not pay you. Let's say historical experience says 5% customers don't pay. Then we need to understand, why is the management working with 10% as an assumption? Are they trying to, showcase lesser profits? Are they manipulating the earnings? Or they are not showing anything. They're saying 0% default. Are they trying to be aggressive on their accounting? So this is something that we need to understand and ask justification on these numbers based on historical data. Inventory cost flow method, as I said, is the company using inventory method comparable within the industry? Is the company using reserve for obsolescence in its valuation? Tax asset valuation. Our valuation allowances must be reasonable. Tax asset must meet the management expectation, right? So because there is areas where human involvement is necessary, this leads to different types of accounting practices. And you would like to curb a lot of this, or you would like to take a cognizant of the fact that why are certain actions being taken specifically. Goodwill, company must do qualitative impairment on an annual basis, right? Sometimes management ignore, they say no, there is no goodwill impairment, but you need to understand, are there any events, particularly, let's say when say events that is negative for a possible impairment, right? Generally impairment happens when there are negative events related to a business. For example, a regulatory restriction implied on the business, loss of a major customer, you know, some brand related issues. These are signs that something is wrong gone for the business, and there's a possibility of impairment. Once again, warranty reserves. Reserves give you the indication about the quality of product sold. If your warranty reserves are going higher, that means the management is worried about warranties getting claimed, and that is also a sign that the quality of the product is not great. The management is trying to, bake in a lot of problems associated with the product. So the signs that you need to pick up: focus on revenues, focus on inventories, focus on capitalization policies. This is related to expense. This is obviously related to revenue, and inventory is going to impact balance sheet. So these are, I think, only a few indicative items where you can look at. You can also look at, for example, cash flows, right? You can also look at several other warning signs available. We need to figure out, is there any revenue recognition principle that is getting manipulated? And therefore, an analyst must examine the accounting policies of the company and compare the revenue growth of a company with its competitors. Because if the competitor growth are, less than 2%, less than 5%, but if your growth is more than 10%, a question should be asked: how? What is the company doing great? Now, there is a possibility the company is doing something exceptionally good. If that is driving the growth, no problems. I think you should be happy. But if this is purely because of accounting that you are able to show higher growth, there is a problem. And attention to inventories, compulsory to check the method and inventory turnover ratio in comparison with competitors or in industry, right? Is inventory selling for everyone, or is it only selling for you? Or are you the only one who's not able to sell the inventory in the industry? If that is the case, I think we need to be very sure that, okay, there is a problem and that problem should be addressed on a larger scale. Now, analyst must note the long-term asset capitalization policies, including interest cost and deferred cost, right? So this is also something that we need to understand, that if you're capitalizing, what is going to impact these capitalization concepts, right? What is going to eventually have an impact on your capitalization numbers? How much is the life that you have taken? Is capitalization generally the trend in the industry, or is it a red flag? And again, compare with industry policies. So the idea is mostly try and compare financial statements across competitors. That is your one of the best ways to look at the financial statement and answer, okay, we are doing good or bad. Continuation to warning signs is cash flow and net income relationships. Cash flow from operation provides actual cash transactions from operations, while analysts must be aware if net income is higher or lower than cash flow from operations, right? So if your net income is consistently higher than cash flow from operation, it's a warning sign for you, because cash flow from operation is telling you cash is not coming in, right? Net income consistently higher from cash flow from operation. This means cash is lower. You're not getting cash in the business. but you're showing very high net income, possibly due to accrual, right? A customer bought a product for $1 billion. So your net profit is $1 billion, but the customer paid zero cash. So cash flow from operation is zero, right? So you can still say that, okay, I have $1 billion of net profit, but my increase in account receivable is $1 billion, which means my net cash is zero. So this is something that we need to evaluate that, okay, simply net income is not your answer. Try and also focus on the cash flow statement and understand, is the cash flow from operation good or bad? Other warning signs, what is the useful life of assets and depreciation method? Is there anything getting changed here? A lot of times people take lesser life. Lesser life means higher depreciation, and higher depreciation means lower profits. Or you can do vice versa. And again, it depends on what the company is trying to look into. Overachievement in fourth quarter, right? Seasonality. Sometimes you tend to report one quarter higher sales, and you tend to tell people that your business is seasonal, which may not be the case. Related party transactions, if there are a lot of related party transaction with your subsidiaries, transaction with related parties, that is again not wrong, not illegal. I'm again pointing that word out. It is not unethical, it is just something which should be studied carefully. Expense classification as non-recurring, very common. So let's say every year you have a loss due to, you know, let's say loss due to spoiled inventory, right? Some of your inventory gets spoiled, or loss due to breakage, right? Your inventory gets broken down, or it simply gets damaged. Now you cannot say that loss due to damage or loss due to breaking down my inventory is non-recurring. Every year it is happening, which means it is recurring. You cannot say non-recurring that, okay, no, this year only we got a damage, next year we won't have it. For if every year that is happening, that is a recurring transaction. Do not classify it as non-recurring. And compare your margins within the industry. Are the margins good or bad? Are the margins something which is in line with what industry margins are? Because again, margins are going to tell you the picture whether the company is doing anything significantly different as a business, or is it purely because of earnings management? It is purely because of company figuring out a creative way to present accounts, which is leading to all this higher profits, etc. So financial reporting quality is something that we have to focus a lot around, and we have to try and assess and understand, are the financial statements of good quality? If the financial statements are of quality, then financial analysis is relevant. Otherwise, financial analysis itself is useless. I don't think there will be any advantage of doing a financial analysis. Now let's look at what are your financial analysis techniques that you can adapt and work with. Now in financial analysis, to begin with, the most important technique is ratio analysis. I think the maximum questions that you're going to face is around ratio analysis. And that is the most important topic from a level 1 perspective also. So when we say financial analysis, we are trying to assess a company's ability to generate and grow earnings and cash flows, and the risk related to these earnings and cash flows. These analysis can be drawn across two things. One, you can do a cross-sectional analysis, and other you can do a time series or trend analysis. So you can do an analysis by comparing to other companies. If you're going to compare to other companies, that is called as cross-sectional analysis. But if you're going to compare it to your own company, which is then it is called as a time series analysis or a trend analysis. So if you're comparing 2023 to 2026 data, that is time series. But if you're comparing 2026 of company A, B, C, and D, that is cross-sectional. This is only company A from 23 to 26. It's time series. But if you're comparing company A with its competitors B, C, D, then that is time series, or that is cross-sectional analysis. So the choice is at the end of the analyst choice. Do you want to do a cross-sectional competitor analysis or time series trend analysis? Cross-sectional analysis is also known as benchmarking analysis, right? This is also in common words known as benchmarking analysis, right? Or peer group analysis. You're comparing your company across a peer group. Now, whichever you do a cross-sectional or you do a time series analysis, you will have to process the data and gather the data from different sources. That processing part will include either ratio analysis, common size analysis, regression analysis, or a graphical analysis. It's up to us. What do we want to use as a technique to analyze information? But the idea is, why would we like to do this? What is the objective of financial analysis process? The analyst should know the reason for performing this analysis, right? The objective, analyst should understand, why is this getting done? Are you doing it for investment purposes, right? Or are you doing it for lending purposes? Are you doing it as an employee because you're trying to understand, is the company good enough? Or are you doing it as a government for tax purposes, right? Again, everyone has a different objective in their financial statement analysis. So analyst should identify what data is required and which technique to be used, right? Mostly financial statement analysis will require financial statements, right? In any analysis that you're going to do, you will need financial statements to a larger extent. Use customized methods depending on specific situations, right? So again, the methods will change depending on your requirements. Analysts should be aware of factors that could influence the analysis and should know the limitations. Now, this is important. What are the limitations of the process that we are going to read? First, accounting, right? You may have accounting which is not consistent, right? Each company may have a different type of presenting accounts. So if accounting is not consistent, then there is a possibility that you may not be able to do a lot of comparison. There are limitations of the technique, right? If accounting is not consistent, if they don't follow the same accounting practices, right? Which is why we say accounting framework is not consistent, then we may not be able to do any analysis, because then you're not comparing apples to apples. Then the comparison itself is difficult. Okay. In such a case, we typically say it is a problem and we may not be able to, you know, do a good analysis. On the other hand, computation versus analysis. Both computation and analysis are integral part of the process. If computation is wrong, analysis is wrong. If computation is right, analysis may be right or wrong. But computation has to be right. If the computation doesn't work accurately, analysis definitely is wrong. Computation is about what, while analysis is extended into why and seeks reasoning, right? So this you have to get it right. If you do a mathematical error on computation, analysis automatically is wrong. Analysts present analysis in the form of written report, and this report should highlight the basis of conclusions and recommendations. What time frame do we run the analysis on? Generally, 3 to 10 years of data should be analyzed in this process, but again, no guidelines. Nowadays, I think 3 years is a good time frame to analyze. Max to max, we do a 5-year analysis. Not a lot of people go back to a 10-year analysis, right? Most of the people will do a 3-year, 5-year analysis as such, right? 10-year is now more or less stale as a data. Let's start with ratio analysis, right? Analyzes past performance and position and helps you understand relationships useful for forecasting future position, performance, and cash flows. We are trying to assess economic relationship useful for forecasting, assessment of financial flexibility, managers' ability, changes within the industry, and comparability with competitors. So we are trying to analyze all this with ratios. Expect a lot of questions from ratios. Expect a lot of questions, mathematical questions, analytical questions. Expect a lot of questions from ratios largely. Now, as we said, there are certain limitations of ratios. What are these limitations? They are not useful in isolation, which means you can calculate your company ratios, but you can't do much with it. You have to always compare ratios to prior period or expectations and industry peers. If I tell you that return on equity is 30%, right? If I say return on equity is 30%, you cannot do anything with this. This is useless. You need to compare this 30% to something. Then I will tell you, okay, historical ratio was 20%. And now you can tell me, okay, the company has done good. Industry ratio is 25%. And now you know, okay, the company is doing better than the industry. So in isolation, the ratios are useless. You can't do anything about the ratios using isolated data points. But then there's another problem, different accounting treatments. As we said, when you are analyzing non-US firms, every company or every accounting framework will be different. So getting an appropriate right accounting treatment is also important. Finding comparable industry ratios. What ratios are important in an industry is something that we need to understand. For example, for IT companies, the important ratio is EBIT margin. But for manufacturing companies, maybe gross margin is also important. So we should also understand industries, companies that operate in multiple industries. Then you need to figure out what is the comparable industry ratio even for conglomerates. All ratios, as I said, must be viewed relative to one another, and determining the target or comparison value also requires a range. Is 30% good or is 30% to 35% good? That range has to be established. So ratios in itself are important, but standalone basis, they can't do much. You have to be careful when you apply these ratios from an analysis standpoint, because there is a possibility you may not find accurate data points. Fair enough? Okay, let's begin with ratios. Now, along with ratios, the first thing that ratios we learn is common size. And most of the companies will generally set up a common size statement. Now, common size statement can be vertical or horizontal. There are two types of common size statement, vertical and horizontal. Vertical means if you're doing a vertical common size income statement, this means divide everything by sales, which means divide sales by sales, divide cost of goods sold by sales, divide any expense you have by sales, divide profit after tax by sales, which means vertically divide everything by sales. So whatever data you have, you keep dividing each data by sales. And what you will get is a vertical common size statement. All the numbers will be expressed as a percentage of sales, right? Express everything as percentage of sales for vertical common size income statement. Vertical common size balance sheet express everything as a percentage of total assets. Cash by total assets, liabilities by total assets, debt by total assets, inventory by total assets, other liabilities, current liabilities by total asset. So divide everything by total asset if you have to do a vertical common size balance sheet. So keep dividing everything by total asset. What is vertical common size useful for? And a lot of us on a daily basis make vertical common size statements while doing, valuations, while preparing client data, while teaching financial modeling, right? So if I'm teaching financial modeling to a lot of people, I'm asking them to make all this on an Excel sheet. We design vertical common size statements there also. This is useful for trend analysis, which changes over time. Cross-sectional analysis, again, comparison to competitors. This also helps you understand difference over time. For example, why is the cost of goods sold by sales ratio declining from 2020 to 2026? The ratio was 60%, went to 58%, went to 55%, and now went to 50%. Right? Why is this ratio declining every year? So you will only able to understand that once you know that the ratio as a percentage of sales is declining. So this is something that is very useful from a vertical common size statement perspective. Low variability over time is useful for forecasting. So if your numbers are keep falling like this, there's a problem. I don't know what should I forecast. But if your numbers remain relatively flat, then I know I can assume the same number for the future also. I can do the forecasting easily. So remember, vertical common size income statement divided by sales, vertical common size balance sheet divided by total assets, everything by total assets. What is a horizontal? Now in horizontal, first you choose a base year. So you will say this is my base year. You will have to choose something called as a base year. And then you divide every item horizontally by base year data, right? You divide everything by the base year data. For example, if cash was 1200 here, 1500 here, and 1800 here, you will choose this as a base year, divide this by 1200, you will divide this by 1200, you will divide this by 1200. You will divide every year data by the base year information. You will say receivables were 2000, receivables went to 3000, receivables went to 4000. Divide everything by receivables base year number. This is the receivable number. So horizontal common size statement, you just have to select a base year. Ensure base year is a normal year. Do not take years in which you have abnormal data. Like we do not take 2021. 2021 is a very bad year for base year because 2021 saw the impact of COVID. So we generally take a normalized year. A normalized year could be, let's say, 2025 or maybe 2026. Normal year, right? And again, take a normal year to do your horizontal common size income statements. Now, what is the general rule for ratios? For ratios that use income statement item, use the value from the current statement, which means everything from the income statement will be of 2025, right? Let's say December 2025. So we are going to use January to December 2025 financial. Now, wherever I'm going to say balance sheet, you can use the value as an average. So balance sheet will be balance sheet value of 24 plus balance sheet value of 25 divided by 2 average. And if you don't have 2 years of balance sheet, then use only the current year balance sheet. So use the values from current income statement and use the value from current balance sheet. For ratios where you have both income statement and balance sheet, use average. For current income statement, just use income statement. For balance sheet, use average. Okay. So for ratios where you have income statement and income statement in both, 25, 25. Balance sheet both, 25, 25. But income statement, balance sheet mix or balance sheet, income statement mix, average for balance sheet. Just be careful when there is a mixed ratio, the balance sheet number will be an average of the data points. Clear? Let's get into that using Now let's start ratios and use a lot of this information that we've gathered from a ratio perspective. Now, when we say categories of ratios, ratios are split into four broad buckets. There's activity, liquidity, solvency, and profitability. Each of these buckets has several other ratios within the bucket. Like for example, activity ratios has three or five different ratios to study. Liquidity ratio has its own set of ratios to be covered, and similarly solvency and profitability. Let's start with each of these buckets. First, let's talk activity ratios. And activity ratios has three ratios related to receivable, payable, and then there is a ratio related to inventory. Each of this receivable, inventory, and payable has two ratios each, and their formulas are very, very similar. So try and remember the formula also. Like when I say receivable turnover ratio, so I am saying annual sales upon average receivable. This is a mixed ratio. Sales comes from income statement, receivables comes from balance sheet. So receivable turnover means annual sales upon average receivable. What does it measure? It measures how quickly the receivables are realized. How quickly can you collect money, or you can turn the receivables, realize the receivables. And using this, we calculate days of sales outstanding, 365 upon receivable turnover. Measure of days taken by a company to realize its receivable or recover the money. In simple language, this ratio is telling me how many times do you collect money in a year or in a period. Obviously, you want this ratio to be higher. You want to collect money multiple times from your customers. If this is higher, automatically your days of sales will be lower. Number of days your customers take to pay the funds or pay the money to you. Perfect. So ideally, we would want receivable turnover to be higher. If there is more receivable turnover, which means I am meeting you 365 times a year, then that automatically means every day I am collecting money from you. So if receivable turnover is higher, that automatically means days of receivable or days of sales outstanding is lower. That automatically means days of sales outstanding is lower. Similarly, payable turnover and number of days of payable. Payable turnover means how many times do I make the payment to my vendors. I would want this to be lower, which means I don't want to make the payments every day to my vendors. I would want my payable turnover to be lower. And if I'm looking at payable turnover to be lower, my number of days of payable automatically should be higher. I would like the payment days to be higher, which means I would like to delay the payments as much as I can from the days of payable category. So number of days of payable should be higher and payable turnover should be lower. Formulas are very similar. Annual sales upon average receivable, annual purchases upon average payable. 365 by receivable turnover, 365 by payable turnover, right? So they are very similar in the fashion in which the ratios are written. If you look at inventory, you will find a very, very similar style in which the ratio is written again. For inventory also, we are saying a very, very similar style. We are saying how efficient is inventory management, which means how many times, or rather how many times is the inventory sold? Is the inventory selling? If the inventory is selling multiple times, the inventory turnover ratio will be higher. And that is exactly what you need. You want your inventory to sell as much as possible. And if you sell it faster, if the turnover is high, the days of inventory on hand will be lower. 365 upon inventory turnover ratio. You would want your days of inventory to be lower, which means you don't want your inventory to sit in your warehouse for a very long period of time. You would want this to be as low as possible. So ideally, the days of receivable should be lower. The days of payable should be higher, and the days of inventory should be lower. And turnover ratios are mirror image. Turnover ratio should be high, turnover ratio should be low, turnover ratio should be high. So the turnover and the days ratio are mirror image. Clear? So activity ratios, these 6 ratios to begin with are important. And then we'll talk about the interpretation of each of these ratios. But formula wise, cost of goods sold are the same. 365 upon inventory turnover, 365 upon payable turnover, 365 upon receivable turnover. Denominator for all of them is the same. Average receivable, average inventory, average payable. The only thing changes is the numerator. Inventory has cost of goods sold, receivable has sales, and payable has purchase. That is the only thing worth remembering. But these ratios are critical to define the working capital for the business. Receivable, inventory, and payable ratios are very, very important from a working capital perspective. This is basically activity ratios.
Yeah. Would you mind to repeat the first one? I think I want to understand the, yeah,
Yes, I
please.
will do that.
Yep.
Let me just find a white colored slide for you. Yes, this is better. I'll write it here for you. The first one was receivable turnover. Receivable turnover means how many times do you go to collect money from your customers, right? So it is basically sales divided by average receivables. It is telling me how many times do you meet customers and how many times do you meet customers to collect money. You would want this to be higher. You would want to meet your customers as much as possible to collect money. Now think about this. If I say that the receivable turnover is 180, which means I am meeting you 180 times. This means the days of receivable ratio is 365 upon 180, approximately 2 times. Every 2 day, I come and I collect money. But if I say that the receivable turnover is 90, which means 365 by 90 days, I take 4 days to come and meet you, which is slightly worse than my initial setup. So the higher the turnover, the lesser the days, and the lower the turnover, which means the receivable turnover is, let's say, 200, right? Or let's say actually not even 200, let's say 10. That means I meet you after 36 days for payments. And that is something which may be wrong, which may not be great for my business, that I have to wait for 36 days to collect money. I'm only meeting you 10 times. So that is receivable turnover. And days of receivable is obviously 365 divided by the turnover. So that was the
Clear.
first one. Yep, yep. Now, in activity ratios, apart from receivable, inventory, payable, which have 6 ratios associated to it, right? Receivable has a receivable turnover, days of receivable, or days of sales outstanding, whatever you want to call it. Payable has a payable turnover, days of payable, and inventory has a days of inventory turnover and days of inventory. Then there are fixed asset, working capital, and total asset turnover. 3 additional ratios related to turnover. Each ratio obviously has the same numerator, revenue, revenue, revenue. Denominator is whatever you are trying to calculate, fixed asset, working capital, or total assets. So average fixed assets, average working capital, average total assets. So formula wise, easy to remember, but what do they represent and explain? A measure of effectiveness in the use of fixed assets of the company's fixed asset turnover, which means how how much are you using your fixed assets. If your fixed assets are getting used extensively, your ratio is very high. That means you will have obsolete asset. Think about it. If you have a car, which is a fixed asset, and if you keep driving your car 24 hours, your revenue will be very high, but your car will wear out very early, right? There will be an obsolete asset. The car will have depreciation. So if the ratio is very high, if fixed asset turnover is very high, that means obsolete assets. And if the fixed asset turnover ratio is very low, too low a ratio implies excessive investments in the asset. That means you have a car which you don't drive, right? So your revenue is zero. Your car value is, let's say, $5 million. And you are saying, okay, the turnover is zero, which means I'm not even using the asset. The asset is unnecessary. I have $5 million worth of cars sitting idle in my, garage. So very high ratio is also a problem. Very low ratio is also a problem. High ratio indicates obsolete assets. Assets are going to depreciate, wear and tear. Low indicates excessive investments. Both of them are a problem. Similarly, working capital. If your working capital turnover is very high, that means you are using working capital efficiently or effectively, right? High working capital turnover ratios indicate efficiency or effectiveness, and low indicates money is blocked in working capital, and you're not able to generate any major revenue from the working capital. Just money is just blocked in inventory, receivables, which is not desirable. So high working capital turnover indicates effective use of working capital, while low working capital turnover indicates money is blocked in working capital. Either you're not able to sell the inventory or you're not able to collect the money from your customers. Both of them are a problem. Total asset turnover is very similar. Higher the total asset turnover, more effectiveness is the company using the assets with. But again, for total assets, also the concept that remains the same. The more you use your asset, the more obsolete it will become faster, the more depreciation will be there. And the lesser you use the asset, the lesser will be the ratio. But again, that will be ineffective utilization of your assets. So from an activity ratio, and for most of these ratios, you have to understand there is a fine balance that we'll have to strike off. There is no right or wrong answer here. It's a balancing act. Take an example. If we say inventory turnover in days of sales on hand, right? Days of inventory on hand, it indicates the funds are tied up in inventory. It is used to indicate the effectiveness of inventory management. If the turnover ratio is very high, this can indicate that your effective inventory management is there. You are very quickly managing inventory, selling inventory. The problem is company does not carry adequate inventory and shortage can hurt revenue. If you're selling very fast, you may run out of stock, right? You may have no stock available, right? Stock may not be available. And if the stock is not available, you may lose sales, right? Because then someone else may sell the product and because you don't have inventory available. So very high ratio is also a problem on inventory turnover. And if you have a very low inventory turnover ratio, that is also a problem that will indicate obsolete inventory, which means your inventory is not selling at all. You have obsolete inventory. Then receivable turnovers, days of sales outstanding. Days of sales outstanding indicate time, elapsed time between a sale and a cash collection. You sold a product and the customer made the payment for this after 70 days, which means the DSO was 70. The days of the sales when happened were outstanding for 70 days. The payment did not come for 70 days. These reflect how fast the company collects cash from the customers. It often offers credit too, and this is only available for customers where you offer credit. If your company does not offer credit, there is no concept of days of sales outstanding. High turnover ratio can indicate efficient credit and collection mechanism, which means you offer credit and you also collect the money efficiently. However, companies' credit and collection policies, if they are too stringent, there is a possibility of sales getting lost to a competitor on more lenient terms. Your customers may not like it and they may switch to a competitor who offers a better term or a lenient term. You're only offering 70 days. The other company may offer 100 days of credit and the customers may switch to this company, right? So it's a very, very tricky situation. If you extend credit, customers come to you. And if customers come to you, you have to take some time to recover the money from them. There's a possibility some of the customers may go bad and they may not pay. But if you don't offer credit, customers may not come at all. And in that case, you may lose sales. So in either case, we are saying that there is again a balancing act. You need to figure out what is the industry policy and can you deviate from the industry policy is a big question. Similarly, for payable turnover and the number of days of payable reflects the average time taken by a company to pay to its suppliers. If payable turnover measures how many times per year the company pay off its creditors. If this is high, that may indicate the company is not making full use of available facilities and taking advantage of early payment discount, right? If you are paying very quickly to your vendors, there is a possibility you are taking discount advantages. Sometimes vendors do offer discounts, right? If you pay them early, vendors will offer you a discount of, let's say, 1% or 2% on your invoice. So if you are paying it early, which means turnover is very high, there is a possibility you are taking advantage of these discounts. But a low turnover may indicate company has either trouble making the payments on time or it is exploiting the lenient supplier terms. It is deliberately delaying payments. Both of the things are possible. You have no cash. You have cash, but you are just genuinely delaying payments to exploit the lenient terms offered by the supplier. If you delay it beyond a period of time, suppliers may not like it and suppliers may stop working with you. If you pay it very early, it's a problem for you because your liquidity in hand goes lower. Then your own liquidity crunch is visible. From a working capital turnover perspective, current assets minus current liability is working capital. The formula is CA minus CL. Indicates how efficiently a company generates revenue with its working capital. And high working capital turnover indicates a greater efficiency once again. You are able to turn around the money faster. The last two ratios that we read on activity, fixed asset turnover ratio measures how efficiently the company generates revenue from its investment in fixed assets, right? You are using the car or not. Efficient use of fixed asset in generating revenue is indicated by high turnover, and inefficiency, not driving the car at all, is lower fixed asset turnover. This may say that you have capital intensive business and now your business is operating below its full capacity, which means you have cars, but none of your cars is on the road or getting driven as a cab aggregator. So these ratios do provide a signal in terms of the operating performance of the business also. They are an easy way to understand what is the operating performance of the business. In this category, total asset turnover measures company's overall ability to generate revenue with a given level of assets. And higher ratio generally indicates higher efficiency from the perspective of the business. So yes, I would want my assets to be utilized better, right? The turnover should be fast, higher. But again, with higher turnover, always remember obsolescence comes into picture. Your assets may get wear and tear and you may have to replace it with a newer asset. That is always a possibility. Questions on first activity ratios? All good? Okay. Perfect. Let's take our short break, 15 minutes, and I'll catch up with some water at my end, have a glass of water and be back. We'll take just a 15-minute break because we have a lot of content. I would honestly like to complete it today so that next week when we meet, we start a new topic. Let's see, can we cover the entire content? This is, I think, the most important part of it. I think it's a 10 slide difference, 10 slide this week or 10 slide next week. I will keep the break therefore smaller. I would like to accommodate that 10 slides today if possible. Okay, so let's keep it really short in terms of a break, around 10 to 15 minutes today. I'll eat 5 minutes of your break time, and possibly we'll have only one break today. So take a 15-minute break, and I think then we'll get started with this again. Okay, so take a break, and I think we will see you in another 10-15 minutes. Okay, perfect. I think we can get started next in terms of the discussion that we were having around ratios. So next on the list, moving up away from activity ratios, is liquidity ratios, right? So the next thing that we generally need to talk about is liquidity ratios. Now, what are liquidity ratios and what are they what are they basically constituted of? Liquidity ratios try and explain you companies' short-term liquidity or short-term liquidity position, right? So when we say short-term liquidity, we are saying will the company be able to meet its payment obligations, right? And when we say payment obligations, we are looking at short-term payment obligations. Will the company be able to make all the payment obligations or meet all the payment obligations in the short run? So when we say short-term payment obligations, we talk about short-term assets and liabilities. And in short term, we have two asset and liability numbers, current asset and current liability. So most of the ratios under liquidity are based on current assets and current liabilities. To begin with, current ratio is the first ratio under liquidity, current assets upon current liability. Ideal ratio is 2:1, which means two current assets for every one current liability. So the ideal ratio is 2:1 as per the textbook. Current ratio, you should have two current assets for every current liability in the business. Then there is a quick ratio. It is a stringent format of current ratio. The denominator remains current liability, but in the numerator, we only have those assets which can be quickly converted to cash. So these assets can be quickly converted to cash. Right? So in this category, we have cash, marketable securities, and receivable. These are three assets which we can quickly convert to cash. So only these three assets are taken in the numerator from the current asset bucket. We exclude inventory, we exclude prepaid expense, we exclude other current liability and other current assets, etc. So in this quick ratio, you are excluding certain current assets. Then cash ratio. Cash ratio is further a stringent format of quick ratio where we also exclude receivables. So we are only taking those assets which are equal to cash. Cash and marketable securities are assets which are more or less equal to cash. Marketable security means government bonds, gold, silver, typically assets which are very, very liquid. Both these ratios, ideal case should be 1:1, which means one liability for every one asset in the numerator. The higher these ratios are, higher is the probability that the company will be able to meet its short-term liabilities, right? So the higher ratios are obviously desirable in these categories. In each of the three ratios, if you have observed, we are eliminating certain elements from the numerator. In this category also comes a ratio called defensive interval ratio. Defensive interval ratio basically helps us understand how many days will the company operate without any external funding, without any external funding which has been secured by the business. This ratio gives us the number of days required by the company to meet its expenses through liquid assets. So these are your liquid assets divided by daily expenditure. So let's say if a company has $50,000 of liquid assets and the company's daily expenditure is $1,000, that is 50 days the company can operate. Versus another company which has $400,000 and their expenses are also $1,000, they can operate for 400 days. So this defensive interval ratio explains the concept related to survival without getting any external funding. With the current cash, how many days can you survive or operate as a business? Okay. Next, cash conversion cycle. Cash conversion cycle measures the time taken to convert the company's cash into inventory, the inventory into receivable, and these receivable further into cash. Cash conversion cycle, therefore, is is a combination of days of sales outstanding plus days of inventory on hand minus days of payable. So the way to write this and remember this is receivables plus inventory minus payables. How many days do you take to convert cash to a product, product to sales, sales to again collect the money and pay it to your vendors? It's one full cycle of a business. So if a company has a receivable turnover of 5 times, inventory turnover of 6 times, and payable turnover of 10 times, their most likely period of cash conversion cycle is, you can take it on 365 days also, you can take it on 360 days also. 72 plus 60 minus 36, 96 days. Higher the cash conversion cycle, more is your money blocked into the business. So ideally, you would want your business to have a low cash conversion cycle. You should typically have a lower cash conversion cycle. Now, what is the interpretation related to these liquidity ratios? Current ratio, quick ratio, and cash ratio. The three ratios have assets of different liquidity in the numerator, which means higher ratio indicates good liquidity, and there is no sacrosanct number here, right? So again, also remember, if the ratio is very high, let's say you have a current ratio which goes to 11, 12, 13, right? Which means this is a very, very high current ratio. A very high current ratio may also be possible because of the money stuck into assets. You may not be able to sell inventory. It's a bad sign. You have a lot of current assets in the form of inventory. You're sitting with obsolete inventory. That is also a cause of concern. So current ratio, quick ratio, and cash ratio, if it is very high, is also a sign of problem. So there's always a trade-off. You would want the ratio to be something which is reasonable to an extent. Defensive interval ratio. Defensive interval ratio again measures how long the company can continue to pay its expenses from its existing liquid assets without receiving any additional cash inflow. And a higher ratio again indicates greater liquidity. Then comes cash conversion cycle or net operating cycle. This indicates the amount of time that elapses from that point when a company invests in the working capital until the company collects cash. And remember, we are calling it the net operating cycle. Cash conversion cycle or net operating cycle is receivable days plus inventory days minus payable days. But if someone says calculate only the operating cycle, you don't want to calculate the net operating cycle. Operating cycle is just R plus I. Do not subtract payables from it. Receivables plus inventory is your operating cycle. Third category of ratios are solvency ratios. So like liquidity was telling you short term, solvency ratios help us understand company's ability to meet its long-term obligations. Will the company be able to meet its long-term obligations, right? Will the company be able to make its long-term payments? And whenever it is about long-term obligations, it is largely about debt. Will the company be able to meet its debt obligations, pay the debt obligations? First in this list is financial leverage as a ratio, which is debt to equity ratio. Total debt, which is long-term debt plus interest bearing short-term debt divided by total equity, right? So both, when we say total debt, it will include long-term and short-term debt. So total debt divided by total equity is debt to equity ratio. Then other ratios which you would like to measure here, debt to capital, debt divided by debt plus equity. Remember, debt plus equity is the total capital a business has. Debt to asset and financial leverage has another format, assets upon equity. This ratio is also called as equity multiplier. Equity multiplier. Ideally, all these ratios like debt to equity, debt to capital, debt to asset should be lower the better. The best possible scenario for all these three ratios is debt equal to zero. If a company has zero debt, the ratio is zero. So ideally, debt to equity should be as low as possible. Debt to capital and debt to asset should be as low as possible. What a financial leverage ratio does, a financial leverage ratio explains how much of your assets are financed using equity. So are most of your assets financed using equity? This ratio, higher is better. This will help you obviously increase profitability. But given this is a leverage ratio, if your company is making losses, the same ratio will enhance losses. It is going to magnify losses also. It will going to magnify profitability also. It depends whether the business is profitable or the business is loss making. Now, if the company has preferred shares, you can classify it as common equity if it is mandatorily redeemed. If it is mandatorily redeemed or is a redeemable preference share, right? There are shares which are called as redeemable preference shares. If it is a redeemable preference share, then you will treat it like debt. And if it is not a redeemable preference shares mandatorily, then you can treat it like equity. Remember, preferred shares are hybrid securities. They are sandwiched securities. So they can be treated either ways. Now, solvency ratio also has a couple of additional ratios, which includes interest coverage and fixed charge coverage. Both the ratios to begin with should be higher the better. What are these ratios? These ratios try and explain us the ability of a company to service its debt. Take an example. Interest coverage is EBIT upon interest. Two companies. One company has an EBIT of 10,000 and interest payment of 5,000, which means the ratio for this company is 2. The other company has an EBIT of 10,000 but interest expense of 2,000, which means the interest coverage ratio is 5. Now this company is better because this company can pay 5 times more interest and still operate comfortably, right? The company can borrow more. By borrowing more, the company can pay more interest. And if the company pays more interest, the company will still be able to survive. The company can take more leverage, more debt. 5 times is the interest coverage. while the first company will only be able to cover interest 2 times, which means currently it is paying 5,000. It can just take additional debt and take it to 10,000, after which the company will not be able to meet debt payments or cover its interest. So higher the interest coverage ratio, better the business. What is the difference between the interest coverage and fixed charge coverage ratio? The difference is only lease payments. Now, if the business is lease oriented, like airline as a sector, if it's an airline company, it's an airline, then lease payments are very common. Then in both the numerator and the denominator, add lease payments. You're trying to understand how much of the fixed charge can the company cover, how much of the fixed payments can the company make. So airline as an industry is something that we focus on when we are doing fixed charge coverage, or any industry which has lease as part of the business model. Again, both the ratios should be higher the better. From an interpretation perspective, debt to asset, debt to capital, debt to equity. If these ratios are higher, risk is higher. Similarly, as I said, financial leverage, if the ratio is higher and if the company makes losses, there's a problem. Ideally, these ratios should be lower the better. But interest coverage, higher the ratio, stronger the solvency. And fixed charge, again, higher the ratio, better the quality of company's preferred dividends, or the better the quality of solvency. Higher ratio once again indicates stronger solvency. The last set of ratios are profitability, and this brings a couple of most important ratios from finance and from an exam perspective also. First, profitability brings margins, all types of margins. There are different types of profits, like there is net profit, there is gross profit, there is operating profit or EBIT, or you can call it a pre-tax profit. Rather, this should be EBT. Pre-tax profit is EBT, earnings before tax. You have paid interest. Now, if you have 4 different types of profits, and if you divide each profit by sales, what you get is margins: net profit, gross profit, operating profit, pre-tax margin. Obviously, these are all profitability ratios. So profitability ratio is higher the better. Higher the profitability, better the ratio. Whether that is net profit, gross profit, operating profit, or pre-tax margin. Each of these ratio, higher the better. These ratios are easily available when you do a vertical common size income statement. You remember vertical common size income statement, we said divide everything by sales. So if you divide every number by sales, you automatically get profitability ratios. Now in profitability ratios, we come across 3, 4 more important ratios. Return on asset can be expressed in multiple formats: return on equity and return on capital. First, if we are saying return on asset, denominator is total assets. Return on equity, denominator is total equity. Return on capital, denominator is total capital. Easy to remember, right? What do you have to write in denominator? Numerator on return on asset is net income, which is nothing but profit after tax. On equity, again, net income, nothing but profit after tax. But on capital, you are going to take operating profit or EBIT. Return on asset can also be written like this: net income plus interest expense into 1 minus tax upon average total assets. Or operating return on asset can be used using operating income. Now in exam, if there is an ROA, they will generally be expecting you to use this. And if they say operating return on asset, they will expect you to use this. This is not used. This is more or less just to explain a concept where interest expense is adjusted. But for now, you can ignore this. Focus on this. If they say ROA, and if they say operating return on asset, then use operating profit or EBIT. Before we understand these important, all are return ratios. Higher the better. Profitability related ratios, return related ratios. Everyone would want return ratios to be higher, the better. Now, what are these ratios trying to explain? When we say return on asset is telling you operational efficiency of a business. This is simply explaining you operational efficiency of a business. This is very useful ratio to compare companies where the balance sheet size is very different, where your balance sheet is not similar or identical. Balance sheet size is different, which means let's say one company has its own assets, the other company leases assets, and both of them do the same business. In that case, how are you going to compare the business or compare the company? You are going to compare them on return on assets, because return on asset takes care of the balance sheet differences. It takes the balance sheet out of the equation, right? And it is your choice. You can run the business by buying the assets. You can run the business by putting the assets on lease, right? So you can take the assets on lease and then run the business. Return on equity tells you return generated for equity shareholders, and this is the return generated for all capital providers of the business. So the return generated by different capital providers or equity shareholders of the business. ROE is something we are going to spend a lot of time today on. We are going to learn a concept called DuPont analysis. So return on equity has a method called DuPont, and we are going to shortly focus on this. So ROE will again get our attention shortly. Margins, in terms of explanation, gross profit margin. If you have a very high gross profit margin, that means your cost of goods sold is lower. And lower cost of goods sold means your procurement is very good. You get raw materials at a cheaper rate. You have some competitive advantage. Gross profit can only be higher when your cost of manufacturing the product is lower, then your gross profit is higher. Operating profit margin is governed or is impacted by operating expenses, OPEX. A declining operating profit could be an indicator for the deteriorating control over the operating cost. If your operating cost tend to increase, that is a possibility your operating profit margins will decline. So it's an indicator that your cost is increasing. Pre-tax margin can indicate possibly an increasing non-operating income that may not be sustainable. So pre-tax margin can get impacted because of non-operating income or other income. And then you have net profit margin. A company's net profit margin is required to be adjusted for non-recurring items to gain better understanding of future profitability. So for us, I think the two more important margins are gross profit margin and operating profit margin. But reporting wise, all the profitability margins are reported. Each of them can be impacted by some other non-recurring items or non-operating items, like other income can impact this, and even some non-recurring items can impact net profit margin. Return on asset, the higher the ratio, the more income is generated by a given level of asset. The formula we already talked about. Some analysts prefer to add back the interest income to the numerator. And this is the concern. In exam, they generally don't touch upon this aspect because they won't leave an option that you use this versus I'm using this. They're very clear. If it is an exam, just use the simple operating return on assets as net income upon average assets and get an answer for the exam purposes. This is more of an analytical adjustment which some investors may want to, or some analysts may want to do. Total capital measures returns before deducting the interest on debt capital on EBIT. So EBIT upon total capital. And return on equity is, as I said, PAT upon total average equity. Measures return earned by company on its equity capital, including minority equity, preferred equity, and common shares, all type of equity capital. Now let's get to DuPont. We already talked about DuPont when we do equity as a subject, but I think DuPont is a very important topic and a very important format of ratios, right? DuPont helps us understand decomposition of ratio. DuPont comes into two formats, 3 form and 5 form, which means when you say return on equity can be broken down like this. You can write the same equation in the format of return on assets upon financial leverage, which means net income upon average total assets upon equity. Total assets and total assets will cancel out each other. What you will get is net income upon average equity. So this is one way of writing it. ROE can be written as ROA into financial leverage as a ratio. Now, more than this, I think what is more important is three format or three-part DuPont. Three-part DuPont means you are going to break the return on equity into three format. Net income upon revenue, part 1, that is net profit margin. Revenue upon total asset, part 2, which is asset turnover. And total asset upon equity, part 3, which is leverage. And now you can better understand why your return on equity is increasing or decreasing. We've talked about this while we were studying equity, that simply telling me that the ratio is 18% versus last year when it was 20% doesn't help. You have to tell me from previous year to current year, why did the ratio decline? And that will only be assessed by breaking it into smaller ratios. You will have to calculate the three ratios for both the years and then help me understand that, okay, the net profit margin declined, which is why the return on equity declined. Or the turnover declined, company did not use the assets better, therefore the ratio declined. Or was it because of leverage? So the reason to decompose return on equity into three-part ratio is to assess what is leading to the decline in the ratio. Further, the same can be broken down into 5-part, which means the first component can now be broken down into 3 subcomponents, 1A, 1B, and 1C. We'll keep the second and the third component as it is, but we will break the first component into 3 subsections. 1A means EBIT margin, EBIT upon revenue. 1B means EBT upon EBIT, interest burden. The difference between the two is I, or interest. And the difference here is tax. Between these two, the difference is tax. This is PAT. After tax, before tax. So tax burden. Now you have 5 ratios. 1, 2, 3, 4, 5. And now you can explain better why is the company ROE increasing or decreasing. Is it because of tax burden? Is it because of interest burden? Company has saved taxes or paid more tax. Company has saved interest or paid more interest. Operating margin, asset turnover, or leverage. What is driving this impact? So the reason to break the return on equity into 3 or 5 form is to analyze the reasons for the decline or a better performance of return on equity. Comfortable? Questions? Anything that bothers you? Just give me a minute, please. Sorry. Oh, yes, perfect. Oops, sorry. Share the screen again. Damn it. Okay. Now, what is additional in terms of analysis? So we did what is called as ratio analysis, and we did talk about, okay, in ratio analysis, you can, do activity ratios, you can do liquidity ratios, you can do solvency ratios, or you can do what is called as profitability ratios. That is one way to analyze a company using ratios. You can also do common size income statements, where you can do a vertical common size or you can do a horizontal common size. Besides this, what are the other methods for analyzing a business performance, forecasting, or modeling? You can basically do regression. A lot of people do regression analysis with company variables. Along with regression, sensitivity, scenario, and simulations, right? So different analysis techniques, and these are not the only techniques, right? To analyze data, to get some, input, some extract or output from the related data set, we can effectively try and model these elements. So there is no, one fit all solution here. Analysis should eventually give you some thoughtful outputs. And that is something that is expected from a financial analysis techniques reading. The reading, as I said, is extensively tested on the examination and is practically one of the most important topics. You should be well versed with the ratios. And a lot of questions around ratios, mathematical, directional analysis, or conceptual questions will be available in the exam. Perfect. This takes us then to the last part of our syllabus, which is financial statement modeling. Now, this has been added new to CFA level 1. This wasn't there for a very long period of time. Over the last couple of years, this has been inducted in the syllabus, and a lot of L1 aspirants also have to pick up a skill-based module of financial modeling. So this reading tries and builds the background around that financial statement modeling as a concept. Now, when we say financial statement modeling, you are going to basically forecast. Modeling is all about forecasting, right? Entire business in finance is about forecasting. There are very few profiles in finance which work on historical data sets. For example, credit rating is a historical database analysis. Banking is something which is obviously not financial statement, but something different as a business altogether. But mostly if you're doing investment banking, mergers and acquisition, corporate finance, treasury operations, a lot of us have to do forecasting, in which we believe we'll have to forecast revenues, operating expenses, expenses related to cost of goods sold, and sales, general, and administrative expenses. You will have profitability forecast, non-operating expense forecast, which may include interest, tax, shares related forecast, and income statement related forecast. Eventually, all of this culminates into a income statement related forecast. So when we say forecasting framework, we need to understand first revenue forecast. Now, if you are going to do a revenue forecasting, revenue forecasting can be based on one segment. So it's not necessary that you will always do it in the same approach, right? Forecasting itself can be very different every time you do it. Even after 15 years of experience, I don't have a template which I can give you and I can say this is the way to do a forecasting. It keeps changing. It is every time a new business teaches you a different way of doing forecasting. So one, you can estimate price and volume. And based on price and volume, you can do a forecasting for a business. For example, you can simply say number of, cars sold by a company, right? So let's say number of Tesla cars sold multiplied by the price of car, or you can say average price of car. With two data points, you multiply, you can get to what is called as revenue, right? So for that, you will need these data points. Then there are also revenue forecasting, which is done based on organic operations and results of M&A. So your own operations, you will do report separately. But if you have acquired a company, that forecast will be different because this is your own business. This is the acquired business. Some companies will report the revenue separately for both the businesses. Further, exchange rate also plays a part in forecasting. If I am an exporter and if I am billing in dollars, it is very important to understand where is the US dollar vis-a-vis euro or US dollar vis-a-vis Singapore dollars, right? Accordingly, my revenue number will change. So while doing a revenue forecast, you will have to keep thinking. Sometimes you cannot do this. You don't get data. So then what do? You take your last year revenue and you multiply your last year revenue with growth. You simply take last year revenue and multiply it 1 plus growth. So if your last year revenue was $100 and you say next year I'm going to grow at 5%, your next year revenue is 105. So you have to be flexible when you do revenue forecasting. It is not necessary that whatever you have learned is the only way to do it. You may have to rethink the approach of forecasting. Then comes operating expense forecasting. Operating expense forecasting will include cost of goods sold, SG&A, and other operating expenses. We have to understand, is there, what is the historical cost ratios, and can the historical cost ratios be used as it is? So estimate using historical margin and analyst forecast of segmental growth. A mix of product is also significant, right? If you change your product manufacturing mix, your cost of goods sold will change. If you have economies of scale, your cost of goods sold will reduce, right? If you have some better raw material sourcing, your cost of goods sold may reduce. Commodity inflation, if commodity prices increase, your cost of goods sold may actually increase. So every time for cost of goods sold, you will have to think what is going into manufacturing process, what is my key raw material, and accordingly, I will have to think what is going to happen in my forecasting. Is the ratio going to increase or decrease? Similarly, other costs like SG&A and operating expenses. You have to always think what is your historical trend versus what do you think is going to happen in future. Like with the current geopolitical tension situation, if oil is your key raw material, a lot of your cost is going to increase because oil prices are trading at a elevated level. So this should be part of your forecasting. You will have to bake this into your forecasting and take a decision. Then comes your operating profit forecast. Your operating profits are typically forecast on a consolidated basis, while your segmental forecast used to check reasonableness of consolidated forecast. Operating profit will be a plus or a summation of all segments, right? All business segments will be added to get to a operating profit forecast. The sum of segmental forecast should be equal to consolidated forecast largely, right? So we keep doing segmental forecast. So if you are, let's say, a movie exhibition business, right? If the company is into a movie exhibition business, you will have segments, right? What could be your segments? You will make money by ticket sales. That is your first segment. Then you are going to make money on food and beverage. That is your another segment. Then you can make money on advertisement. That is your third segment. So we are going to calculate all the segments. And then once we add all the segments, we'll get our consolidated profitability, consolidated revenue, everything on a consolidated basis. Remember, operating profit is a pro forma, which is not GAAP measurement, and you have to clarify inclusions and exclusions in this, right? It is not a GAAP measurement. It's not generally accepted accounting principle. It's a pro forma, means projected number. Further, check segmental margins should be compared to competitors. You should ensure that your margins are reasonable, right? If all your competitors are making 20% on ticket sales as margins, it's very hard to say why would your business survive with a 40% margin, right? Why would people come to you if you are charging 40% margin? So let's be realistic. Let's take numbers which are more reasonable. 20% for the industry, maybe you can do a 20%, 21%, so on so forth. Then while forecasting, we also have to look into non-operating items, which includes net interest, balance sheet debt, cash and investment positions, which is blend of fixed versus floating rates. And you will have to require forecasting of interest rates paid and received. In addition to this, tax expenses, whether you are a partially operating entity, partially non-operating, effective tax rate depends on both operating income and non-operating income. Consider effective rate and its historic stability, right? Are the tax rates stable across the geography? The impact of product mix and overseas operations is also seen here. If you are a locally run business, you don't have any overseas operation, calculations are easy. But if there are operations spread across the geographies, then you will have to look at the tax rules for each geography and bake into your calculations all those tax estimates from different geography, different loss carry forward rules. That is going to complicate this process of forecasting taxes. Share outstanding forecasting again is a bit complicated. You have a potential dilutive instruments like if you remember, we talked about convertible debt, convertible preferred shares, options, and warrants. These are all convertible securities. And if these securities convert, they are potentially dilutive instrument. Your number of shares outstanding will increase. So you will have to make an estimate that how many employee stock options or share buybacks or secondary issues will a company do. And based on those issues or options, will the number of shares increase or decrease? Therefore, forecasting itself is a tedious task, and each line on the financial statement takes a lot of time to identify and forecast. All of this also goes then to cash flow, right? If you have your income statement and balance sheet sorted, this eventually translates to a cash flow. This is called as a three-statement modeling approach. What is a three-statement modeling? You are going to do all the three statements in terms of forecasting: income statement, balance sheet, and cash flow. You will have a cash flow from operation, a cash flow from investing and financing, right? And in which you will take inputs from either income statement, balance sheet, and put them through a cash flow statement. The cash flow gives you two very important items: capex and working capital. Why are they important? Because these inputs then go into a method called as DCF, discounted cash flow method. And DCF method is extensively used to value businesses. So when I say capex and depreciation forecast, depreciation and amortization forecast is a function of prior year plant property equipment and intangibles in the balance sheet. A depreciation and amortization is dependent on how much is your existing plant property equipment and intangibles in the business. So if there are significant intangibles in the business, or if there are significant assets on the balance sheet, then there is a possibility your depreciation and amortization will also be higher. So this is also at times where we realize that, okay, my depreciation amortization is not purely a function of what I'm trying to do here. This is also a function of what my assets are. And we also do capex as a percentage of sales. So a lot of times capex is also done as a percentage of sales. This is one very simple estimate: capex as a percentage of sales. So 2% of sales, 10% of sales, how much do you think you're going to spend on capital expenditure? Because if your sales are not increasing, there is no use of doing a capital expenditure activity. Besides, and remember, capex also drives depreciation, right? The more assets you buy, the more you will have to depreciate it over a longer period of time. The more you spend on buying intangible assets, the more you will have to do amortization. This also brings us to working capital forecast. Now, working capital forecast is a combination of three things: days of sales outstanding, days of inventory on hand, and days of payable outstanding. Because core working capital is a combination of receivable, inventory, and payable. Core working capital is a combination of these three elements only. So in order to forecast days of sales outstanding, days of inventory, or days of payable, we will have to forecast receivable, inventory, and payable. Examine historical trends in these sales days, and using these days, you can forecast AR, inventory, or accounts payable. Simple example, if I say my days of receivable were 10 days, 12 days, and let's say 15 days in the last 3 years, 24, 25, 26. Step one, I will have to estimate what it will be over the next 3 years. So I can say, okay, I'm continuing with 15 days, which means I will collect money from the customers in 15 days. Using this 15 days, then I can estimate my account receivable. I will have to just shuffle the equation. I will have to say account receivable in 2027 will be equal to days of receivable in 27 multiplied by sales in 27 multiplied by 2 divided by 365 minus account receivable in 26. So I can use this equation to forecast the account receivable in 27. Similarly, I can do a forecasting for inventory and for payables. What I've written as an equation is a mere shuffling of the ratio, right? The days of sales outstanding ratio. We have just shuffled the ratio. We have just rewritten the ratio for 2027. All these numbers which we were trying to forecast are eventually useful to calculate what is called as FCFF, free cash flow to firm. Now, what is free cash flow to firm? This is something that we use to do our DCF or valuation of businesses. So EBIT multiplied by 1 minus tax rate is this, also called as NOPAT, net operating profit after tax. And from NOPAT, we add depreciation, we subtract capex, and we should actually also subtract working capital, which is missing here, right? Make that correction. Working capital investment, or what is called as increase in working capital, needs to be subtracted. And what we will end up with is free cash flow to firm, or FCFF. So NOPAT plus depreciation minus increase in working capital minus capex is free cash flow to firm. Now, what are the behavioral aspects from a forecasting perspective? First, overconfidence. Analysts have had overconfidence in their abilities to forecast. And how do you mitigate this behavioral aspect? Peer review, analysis of previous forecast, and scenario analysis. So always think about, when you're forecasted, how do you believe this is going to impact? What are your peers thinking about it? How does your forecast compare to the historical data? and various type of scenario analysis, which could be, base case, best case, worst case analysis. So avoid overconfidence. Second, illusion of control, which means there is a belief that more information will improve accuracy. A lot of people believe the details, if I get a lot of detailed data, I will have better accuracy. The belief is that more complicated models are more accurate models. This is nothing but illusion of control. It is not necessary that a complicated model has a better accuracy. Reality is marginal returns for additional data diminishes, which means more data can be overfitting, or more data is something that is going to not give you enough good results, right? It's basically diminishing utility. So restrict the model to key variables. That is, I think, the focus area in terms of modeling. Just focus on the key variables. Confirmation bias. Focus on information that confirms past beliefs and ignore information that contradicts. So you only tend to focus on information which you believe is in confirmation with your past beliefs. You are completely ignoring the new information because that is contradicting to your analysis. The mitigation measure is read analyst recommendations that contradict, peer review by colleague with no psychological investment in the security. So learn to accept new information and incorporate that new information in your analysis. What could be the other aspects which may not do well from a forecasting perspective? Conservatism bias, which means you are sticking to the original forecast and you fail to update for new or conflicting information. Which means an analyst who is suffering from conservatism bias does not adjust to new data. And even if the adjustment is there, it is very small. Mitigation, once again, peer review and flexible model with fewer variables. Try and make the models more flexible from that standpoint. Representativeness bias. Information categorized based on past experiences when in reality it is different. Inside view, specifics of the situation or the company. Outside view, industry average norms. In either case, you are trying to look at the information in a completely different view. The insider believes our data is correct because we are talking from a company point of view, specific to the company, while the outsider believes that, okay, the industry data is better. Both of them are representing a different group of analysts or a different group of people, and therefore they are representing their biases. Consider both inside and outside view to get a better picture, right? You don't focus or don't hinge or make your analysis based on a single data point. Otherwise, it may lead to results which are biased. Now, the forecasting is also dependent on industry attractiveness.
Sorry.
Yep.
Yeah.
Sure, please go ahead.
Yeah. In terms of these, let's say, behavioral issues, I'm
I'm
very, I
losing your
think,
voice actually.
yeah. I
Hello?
am saying yes. Are
Can
you
you
hear
please
me?
repeat?
Yeah. Based on these behavioral issues,
No.
would
I
you
am
just
unable to hear you. No. Your audio has some issues, Shao. It's very difficult to hear you.
oh, okay. And now,
If possible, yeah, maybe you can just try type in a message for me.
all right.
I'll wait for your message and then I think we'll move forward after answering your query.
Hello?
Yep. I can hear you better, but I'm just waiting for your message if that helps, or you can try and speak again. Maybe you are better this time around in terms of quality. Let's try the audio route. Maybe your internet connection is better now. Or maybe that is a problem at my end.
Now it's okay?
Absolutely. This is wonderful.
Okay. Yeah, it's let me just explain me again the two particular issues regarding to behaviors, confirmation bias, because and the representative bias, it seems that they are one thing in common, that is past information, yes?
So in confirmation bias, yes, you are focusing on the on the past beliefs and you're ignoring information that contradicts. So you're only trying to
Oh,
read information which confirms your bias. So this happens a lot of times. You have made an analysis. So you have agreed, okay, Tesla is a good company. I want to invest into Tesla. And now if there is any negative news, you are ignoring the negative news. You are just picking news which is confirming your analysis. That is confirmation bias. While representativeness bias basically means, yes, your information is based on past experiences, but you are now focusing on only one set of representative data as an insider, as an outsider. It doesn't say that you are ignoring, uh, you know, contradictory information. You are only taking one set of information which is representing you as a group. So I think that
okay.
is the key difference.
Okay, thank you. Thank you.
Yep. Okay. Now, industry analysis is equally important when you are doing, you know, forecasting, and specifically the price and the cost behavior of a business. Porter five forces model that you see here tells you industry attractiveness. For example, if there is a threat of entrants, if there are new people who are going to enter the industry, then your pricing power will be eliminated, or your pricing power will decline, right? So this is going to hurt your revenues. This is going to hurt the pricing. And if the pricing gets hurt, your revenues will also get impacted. On the other hand, power of suppliers. If bargaining power of suppliers increases, then your cost is going to increase on the raw material, right? Because the suppliers may then ask for a higher margin on the raw material cost. Threat of substitutes. If there are more substitutes, maybe your pricing will get impacted. Then you will have to reduce your profitability margin and you will have to compete with existing products. So you may have to sell your products at a cheaper price. Power of customers. If bargaining power of customers increase, again, you will see impact on pricing power. Higher the power of customers, higher the threat of substitute, higher the threat of entrants. Lower is your pricing power in either of the cases. Higher the bargaining power of suppliers, higher is your cost. And competitive rivalry. If there is more competition, again, pricing will take an impact. So when we say price and cost, you will have to also understand what is happening with these five variables. Is there bargaining power of supplier, bargaining power of buyer, threat of substitute, threat of entrants, or rivalry among competition? The industry is considered to be attractive if most of the five forces are weak, which means you have a very low, you know, low bargaining power, or you have a very low pricing impact, right? But if the powers are on the higher end, then you are saying that the industry then is becoming challenging and you may not be able to make a lot of profits. If all of them are higher, it is negative for you. Pricing fall is negative and cost increase is also negative. If all of them are lower, then the industry is attractive because then you have high pricing power and low cost structures. That is what is desirable for a profitable business. This is called as Michael Porter's five forces model. Now, there is also an impact of inflation and deflation on forecast. Mostly when we are doing sales projections, we pass on the higher cost via higher prices to the customer, right? The projection always believes that if cost is going to increase, that will be passed on to the customer, which means higher cost will result in higher prices. But in certain cases, we can accept even lower margins. It's not necessary always this happens. In certain cases, if cost goes up, I may not increase the price. I can keep the price flat. And in that case, my margins are going to reduce, right? It's a simple math. What is the factor to consider? Will you pass the price hike or not, right? So if there is a price which has to be increased, or let's say if there is a cost which increases, will you increase the price or will you not increase the price? That is something you have to decide. The decision is based on elasticity of the demand in the market. If it is a product which is very high demand, inelastic product, right, where people will pay whatever price you ask them, then you will pass on. Like, tobacco, right? Or let's say simply cigarettes as a product has a very high elasticity of demand. It's an inelastic product, right? Even if you increase cigarette prices, the consumer tends to still buy it, right? So the price elasticity of demand is for cigarette is something consumers don't avoid because it's sort of an addiction for them. Competitive position. If you are in a monopoly, you may increase prices. But if you are into a perfect competition, you cannot increase prices because perfect competition means you will lose your demand altogether. Impact on exports. High domestic inflation relative to trading partners tend to weaken domestic currency, right? So if your inflation is higher, then your currency is going to depreciate. And if your currency is going to depreciate, it will make your exports more competitive abroad. But reducing will translated revenues when converted back to local currency. So we need to understand from a forecasting perspective, how do you want to normalize this over a business cycle, right? Today, the currency is depreciating, an exporter is making more revenue. But sometime the currency is going to appreciate marginally and the revenue will come down. So in a business cycle, you have to understand when do I need to increase and at what time do I think the revenue is going to normalize. So that normalization has to be estimated based on forecast. And which is why your forecast and my forecast could be different, right? We may not have a very similar looking forecast. The way we think is also different for each business, each product. Inflation, deflation also impact your cost. You will have different cost which will inflate at different rates, or the geographic rates may differ. Simple example, if you are sourcing coffee beans as Starbucks, if you're sourcing coffee beans from different geographies, the cost of that coffee bean is also different, right? So if it is coming from Africa, if it is coming from South America, you will have a different cost. While projecting cost, factors to consider are, is the company using forward contracts to delay impact of price increase? Is the company hedging basically? Then analysis of inflation's drivers. Why is the inflation rising? Is it something which will be controlled? Is it short term or is it long term inflation? Like for crude, we have been talking, the crude has gone like this, but we know that the crude is not going to sustain at these levels. It is going to come down, right? Sustaining at $100 plus level for crude is pushing the world into a recession for a lot of economies. So this is going to come down and stabilize around that 70 $60 range over a period of time again. That is the range where everyone is happy. So we know this is a short-term spike, right? But as soon as there is a mediation or there is a cool down of the geopolitical tensions, the crude oil prices will cool down as well, right? So that is your cost. Then power of supply, as we talked about, switching cost and cheaper alternative available as suppliers. Yes, if cheaper alternatives are available, your cost can come down. And reduction in discretionary cost to preserve margins. right? The reduction in discretionary cost to preserve margins. Can the company manage some of the cost, reduce some of the cost, which is discretionary in nature, which is not mandatory, and preserve margins? For example, a lot of times companies, you know, cut salary cost, right? At times they say we are not going to give a salary hike this year to preserve margins, right? So that is something that can be done and margins can be preserved. Forecast horizon. How long should you forecast? Now, this is subjective. In general, a 3 to 10 year is a good time to forecast. Plus, you can also match your investment horizon. If you have an investment horizon of 5 year, forecast for 5 years. Capture cyclicality of industry, right? So if the industry is cyclical, right, maybe has a 3 year up cycle, has a 3 year down cycle, then it's a 6 year cycle, right? So then you can capture the midpoint of the cycle and you can say, okay, let's take somewhere around a 4 to 5 year cycle and try and model it accordingly. Again, company specific factors and analyst preferences depends, right? As I said, each analyst can have a different time frame of forecasting. In certain sectors, we forecast for 20, 30 years because these are sectors with high gestation period. Initially, the cost is very high, such as infra, biotech, because you're going to spend first 5, 6 years only to create an infra project. Your cash flows are only going to come after 5 years, right? So infra and biotech sectors, you may extend the forecast to 20, 30 years also. Now, when we do forecast, we cannot forecast beyond a time period. Like for example, I have done a forecast for a business for let's say 3 years, 1 year, 2 year, 3 year. Now, what happens after 3 year till infinity? I am not forecasting, but my business is a going concern, which means my company is going to operate till perpetuity. So the value of the company from your final year of cash flow, from year 3 to infinity, this value between year 3 to infinity is called as terminal value. This entire value is captured in a term called as terminal value or TV. It is the estimate of cash flows beyond the forecast horizon. If my forecast horizon is 3 years, anything beyond 3 years is terminal value. You typically rely on a constant growth assumption. We assume from year 3 to infinity, there is a constant growth G. And this is where we use the model which you have read elsewhere, the Gordon growth model, or what is also called that constant growth model. In equity, maybe you've read this or you will read when equity is covered. Constant growth versus or Gordon growth, call it anything that you want. So terminal value is value of the business after the last year of forecast. Now for each of the companies, you will typically indicate which of the choices is least likely to cause a change in company's outlook. Like ABC Diesel, a manufacturer of diesel powered trucks, consumers have started switching to trucks with electric engines, threatening ABC's historical strength in diesel engine trucks. And we have to figure out choices that is least likely to cause a change in company's outlook. So they are a manufacturer of diesel powered trucks and consumers have started switching to trucks with electric engine. This is going to change the outlook. ABC Diesel has formed a partnership with Electrico, a company involved in research and innovation in electric engines. Once again, you are changing your business model. You are pivoting your model. So this is going to change the outlook entirely. Earlier, I was thinking about you as a diesel powered truck. Now you are getting into electric. Environmental regulations have been getting tighter in most regions and consistent with prior experience. This needs to make sure the engines less polluting is expected to continue over the next several years. Yes. So this is in line with what the business is. Environment and diesel is something I'm going to read together. So the inflection point means you pivot. The pivot itself changes. Your business is now pivoting to a different, you know, a different parameter altogether. So if a pivot changes, your business has significantly changed. One more example, Abbott Laboratories, a diversified manufacturer of healthcare products, including medical devices. Management reiterates its long-standing approach to capital deployment. A competitor has demonstrated favorable efficacy data on a medical device candidate that will compete with important Abbott product, and it has become more difficult for medical device manufacturers to receive regulatory approval for new products because of heightened safety concerns. Look, in this case, reiterates its long-standing, nothing changes, right? Your outlook doesn't change because that is what you were already baking in. You already were doing an analysis, keeping this outlook in mind that, okay, the company is going to continue capital deployment, and that is what is going to continue from here. In other two cases, if there's a new product or if there is difficult for regulatory approvals, then the outlook changes. Then the company, one of them is that it's a negative for the business, right? This is also negative. This is also negative that you would not get regulatory approvals henceforth. So both of them are negative from a forecasting perspective. Perfect. So I think that is all that we have for financial statement analysis. As I said, from today's